So this podcast is just basically just it's not giving advice as such. It's really more just as a general as to what my experiences are, what I've seen, what I've come across, and there's no pros. Nobody's going to win in it, or you can't guarantee any outcomes on it. So this is just really just a general oversight, my opinion, my thoughts and experiences so far.
Welcome back, everyone, to the Property Journey podcast, episode 24. Nearly at about a quarter of a century here, so we are. Jeez, starting to pile these episodes in, so we are. Episode 24, property investment strategies, we're going to be talking about today, and I'm going to pick your brain and see what you can come up with.
That may help. Yes, go ahead.
We're certainly sticking sort of to this topic at the minute, property investment. Want to be able to just do with it. A lot of questions, a lot of people asking about this sort of area of property, so that's why I kind of want to keep focusing on it, because the questions are coming in. Want to keep on it, so do. So I have a list of questions today, Roy, that hopefully we'll be able to get answers to for our listeners.
That's good, because I've been spending the last couple of weeks getting quite a few inquiries and a lot of people wanting to get involved in property investment. So it's the key basics, I suppose, and you kind of forget, when you're doing this day in, day out, it just all comes naturally, and you realise actually you need to break this down into the absolute very, very basics and start from the scratch. So hopefully we're painting a picture and helping to educate those.
100%, and I know myself, even just from starting this podcast, the learning curve that I've been on, and as you break it down, it's a wee bit more easier to divulge. So I suppose probably the first question then is when you're thinking about investing in property, it's the area that you want to go into, what would be the key factors that you would want to consider in terms of a strategy that you want to go for?
Good question. You see, that's oddly enough, a lot of people don't have a strategy. So it's good to sit down and figure out what is the goal, the end strategy. So some people maybe they don't want to maybe put money into an alternative savings method. So maybe they don't want to put money into an ISA or into a bank account. They don't want to put money into a pension or what have you. So then they're thinking that could be a long haul game. So that could be a 30-year strategy. Some people are thinking to themselves, well, maybe I'm at a particular age and they want to retire maybe a wee bit sooner than planned, and maybe want to retire in 5 years, 10 years time. So then they have to think of a strategy. Well, how can they hit that goal so that they can maybe retire or step back? And the main thing is probably just to wipe it out from the very beginning. I get quite a few inquiries in from people saying, right, I want to make a lot of money and I want to make money quick, and I just stop that conversation. And if that's all that you're thinking of, it doesn't work, it's not for you, and I'm not the person for you. So it's all about strategy, and it's generally a long-term strategy, and it's also how much time and effort you want to put into it as well.
We've kind of touched on it, that get rich quick method, which is touted a lot online. It's not really feasible. It's not something that you're gonna, when you start breaking down even fees and breaking down, whether it's your solicitor fees or the estate agent advertising the property because you've went in and renovated it, even your time and effort that you've talked about, doing properties up, the get rich quick it's just not an option.
A lot of the time, these courses and seminars and what have you, they talk about having a portfolio worth £1 million, but really what they're talking about is having debt of £1 million, whereas to me, having a portfolio of £1 million should actually be you want equity of £1 million, as in if you sold it all tomorrow, you'd be sitting with £1 million. So that's not what they're talking about. So that's the first thing. And the second thing is they talk about trying to replace your current income. So for a lot of people, typical salary, somebody 25,000-30,000 pounds, fair enough. You take away the tax implication as to what they have at the end of the month every month, then they try and make that through property. But to make that through property, you're taking on a lot of risk. And some people think, oh, this is easy, I'll get into it, I'll rent a few houses and I'll equal what I'm making at the minute. But that's if everything runs smoothly and if there's any downturn, if there's any issues with your tenants, if there's issues with maintenance, repairs, you very quickly have no source of income, and the whole thing can come toppling down very, very quickly.
I think in the last episode we touched on that vacancy side of things. You know, if you're sitting with a property that's vacant for 3 or 4 months, you know, and you have a mortgage payment coming out, there's 3 or 4 months worth of, say, mortgage payments. You're in the, probably nowadays, what each chat and say, even £800 a month, 840, it's 32, £3,200 that you've lost out that you're having to pay out yourself because you can't relate in your mortgage payments.
Exactly.
It's a big thing in terms of that sort of risk side of things, in terms of even buying, say, one house that you're putting a 25% deposit down on, you're maybe still taking out a mortgage for 75,000. It's still a lot of money to be, as an investment side of things, So the risk side of things, even from that small purchase, I'm saying small because we're talking the relative side of things, but a small purchase, say, for a house at 100,000, when you're chatting about, say, these get rich quick methods or whatever, and they're saying, as you say, debt of up to $1 million, it's
crazy.
When you think about them figures, like, it just, for someone to go and do that, it's, you have to have a serious, I don't know whether I want to say it here, like, but you have to have a serious sort of hard look at yourself, like, to be able to just go and do that. Yeah. Put yourself in that position.
See, I think a lot of people, they don't think like that. They don't think of the risk, and they think, it's only figures on a page. I come across it a lot with the likes of first-time buyers, and they're taking out a mortgage, and they're asking, when it comes to signing the contract, does my girlfriend have to come too to the meeting? And you're thinking to yourself, you're taking on a mortgage here, you're taking on an obstacle for the next 25, 30 years, you're borrowing a lot of money. This isn't something that you take flippantly. You should be speaking to a solicitor, finding out, what's the ifs and the buts here, where am I tied in, what's my penalties, what's the risks. It's just not going to ban a card a couple of grand, and if it doesn't work out, well, sure, a couple of grand generally isn't going to hurt you much.
I know, I do think nowadays, and especially even when you look at the prices of, say, property, that have increased, you are taking on a lot now. If you are going out, even a new build house or whatever, we're kind of going off topic a wee bit here, but you go out, new build house, 190, maybe 200,000 for a 3-bed, you're now putting, say, a 20 grand deposit down, 180 grand's worth of debt straight away, and you are tied into that.
Yeah.
And it is a lot of risk.
Absolutely.
And the flip side of that, as you say, is if you're investing and you maybe have got your own house and you have it paid off, and that's all well and good, but if you go then and begin to take out mortgages and other payments or on other properties, collateral damage there might be the house that you're living in. So there's a lot to think about when you go in, and as you say, if you don't have a plan in place or a strategy in place, surely if you're dealing with those numbers, you should be putting a strategy in place.
It's like running a small business. Whenever you own property, you are a business owner. You need to be, what's the strategy, what's the goal? Are you working on your figures, planning ahead, forecasting, budgets, contingency plans, all of that, because that can be a downfall. There's a lot of it is all about the cash flow of it, and have you enough rent coming in to pay the bills, predicting when are those bills. There's going to be set bills during the year, and it's very easy for people to think to themselves, this is easy, there's money coming in, but you're not talking masses amount of rent money coming in. But at the same time, you've got your rates, you've got your insurance set times during the year, you've got the main one's your tax, and then not only that, depending on how it's set up, you could be paying the tax once a year, or you might have to pay a payment on account, which means you're constantly working against yourself from a cash flow point of view. So and then you then have to factor in, well, what sort of interest rate are you in? Is it locked? Is it fixed? When's it going to change? If that goes up, can you manage that? If the rent goes down, if there's any difficulties, all that has to be factored in.
And a plan and having that all dealt and sort of set out for yourself makes it a hell of a lot easier, so that you can understand it that a wee bit easier. there's obviously then different different sort of styles of what you can do when you are investing, and again this will fall in under your strategy, whether it's buy to let, short-term rentals, maybe flipping, or even going down the route of commercial. Sort of, where do you determine as to what sort of property or what sort of style of investing that you're going for then?
It comes down to the buyer themselves. So to run through those scenarios, you've got the traditional method, which is a buy to let, which means you buy the property, you rent it out, and that's it. Generally, that is if you pick the right sort of property, it has a good level of return on it. But you've got more higher risk, the likes of Airbnbs, so the short term let. Again, that can be very profitable, but you've a lot more work involved in it, a lot more organising, running about, more repairs, what have you. Whereas, as I say, that buy to let's just simply plug and play, and you can generally sit back. And then you've got other methods, the likes of house of multiple occupancies, HMOs, which are similar to Airbnbs. Again, you have a higher investment, particular type of property to invest in, higher returns or higher rents, but you have issues with the likes of regulations, more turnover of tenants, things like that. And then commercial is another option as well. So that's basically, instead of renting out houses, you're renting out business, buildings to business owners. And then another option you've mentioned there is flipping, which it becomes a skill. There's courses out there which they can teach you to be a flipper and things like that. So flipping is basically, you buy a house and you sell it very quickly. You can maybe sell it before you even buy it, or you're buying it for a short time and then you're selling it on to make a profit. There's a massive skill in that. Anybody that I know who does well at that, they make it look easy, but anybody that makes something look easy is because they have a skill. They've spent years upon years mastering it and putting in the hard graft and the grind, which you haven't seen. It's like watching a professional footballer. Everybody thinks that's simple, but they've sacrificed their life to that for maybe 20 years. So flipping, as I say, always be cautious with that.
Again, it's another one, as you say, there's courses out there, and it seems to be another popular method of, you can buy a property and within, a week you've turned around and sold for, 20 grand above what you paid for it. Is it realistic? For most people, likely not. As you say, it's a skill, the experience involved in it, having a team in place to be able to just go in there, and whether you are doing renovation work or you have people lined up, having people around you that you can sell it to. There's a lot to it, rather than just, thinking to yourself, oh sure, I'll buy it here at auction and do it up and I'll flip it on here in the next month.
Yeah.
It's not as seamless as that. What are the biggest mistakes then for investors that in relation to strategies then? What would be the biggest mistakes that you would see, apart from not having one?
Probably lack of research and lack of a strategy. So lack of research as in, what type of property are they going to buy and look after, and does it suit their personality? Because the likes of, to give you an example, if you're going into Airbnbs and you're doing it yourself, well, you have to have that property sitting meticulous at all times. It's basically sitting like a hotel standard, and you're looking at maybe wee small touches that makes you a great host, and that really wants people to come to your property. And if your personality is basically a wee bit of, it'll do all right scenario, or sure, there's a big mark on the wall, but sure, I'm not spending the money on that, and we bit tight, a wee bit miserable, it'll do all right scenario, again, that's not for you. You have to, it's about, if you're meticulous, that suits you. If you are, let's see, what else, HMOs as well. Again, if you want to be hands-on, you have to be prepared. There's going to be more turnover of staff. Are you good on your paperwork? There's a lot of regulations, a lot of inspections, a lot of text box scenarios of electrical alarms, smoke alarms, fire tests. Have that all been tested? Record paperwork of all of that. So again, if you're not an organised person or you lack time, that may not be for you either. So it comes down to personality probably significantly.
As you say, even there, like, you know, touching on that, you know, HMOs, for example, common areas, things like that there, you know, the people that are probably staying in the property would most likely look after their own sort of space or their room. The common areas are probably areas that, you know, you're left up to look after, you know, so if there is, as you say, marks up the walls or things going wrong in the common areas, it's up to you probably to go in and deal with them. And if you don't have the time to be able to do that, then you don't maybe even want the, as you say, is maybe spend money on someone going in and doing that for you, so you don't have to worry about that. Well, you know, that's the ball's in your court then to go and sort it out. When it comes to, well, actually, I was going to say about location here, but because you've kind of mentioned it there, what role then does the market research come in when you're choosing an investment strategy?
Market research is down to, let's say for instance you're buying maybe a typical buy-to-let property. So, you know, again, you want to be looking at, well, how much is the house going to cost to buy? You know, how much, you know, if you're taking a mortgage, how much is that going to cost you, or how much do you need to put in? How much is it going to cost you every month? What sort of rent are you going to achieve? How quickly are you going to get it rented? And then the factors that decide the rent is basically, you know, the likes of the location. Is it close to a railway track? You know, that can have a negative impact on it. Is there a good communication or commuting links? Is it close to schools, close to shops, those sorts of things, and that can all have a big impact. I'll give you an example. Somebody came to me 2 weeks ago there and they wanted their house rented out, and I took a look at it and I says, right, well, I would say we could put this on the market at £800, and their response to me was, no, we need more than that. What do you mean you need more than it? Oh, by the time we pay our mortgage and pay our rates, you know, we need £890 a month. But it's not it's not you, the owner, who sets the rent. It's the market itself. So again, you're coming in to that from the wrong angle.
So the market research then is obviously giving you the perspective of knowing what property you're buying, knowing what you're buying it for, and knowing then what it also will achieve on the market then as when you go to rent it out.
Exactly.
And again then sort of kind of factors into that question then, the location then is important, as you say, where you're renting or where you're going to buy a property. The rents are going to be different in certain areas. If it's close to transport links, for example, you know, people maybe transporting to Belfast, for example, you know, where key jobs are, all the rest of it. You know, houses in a certain area, if it's close proximity to train stations or bus routes or travel links or whatever, you know, is that where the location comes in is quite important then for your strategy?
Absolutely. And then it's market trends as well. So I come across scenarios, like I've been at property now over 20 years, and I'm coming across investors who's buying in particular estates or developments, and I'm thinking to myself, well, I wouldn't be a fan of buying there, because I can remember back in 2012, 2013, you couldn't give a house away in those particular areas. And at that time, there was a number of reasons. Maybe, you know, it was slightly out of town, it wasn't even a village, slightly out of town, no bus whatsoever. And at that time, the rental market was very poor. You know, you had an oversupply of properties and a fewer amount of tenants.
Yeah.
So that has always led me to be a wee bit more cautious, and it means then any developments or any areas that I'm selecting, you know, I try to think there's best protected as possible to basically massage in if there is any slowdown in the rental market.
And you could probably see, as you say there, you know, from even just as simple as house prices in different locations, as they, you know, the importance that they are, or how popular they're becoming, or you know, so probably in and around this area you would have the likes of Lisburn, for example, would be, because of its close proximity to Belfast, the house prices probably are slightly dearer there than what they would be maybe further south or further away on down the motorway a wee bit.
Yeah.
So again, that all has to be factored into your strategy when you're thinking about what you're going to do when you go to start investing. In terms of the finance options, then we've touched on this on a few of the previous podcasts, but you know we'll divulge into it here. When you're strategizing about your property investment, what kind of finance options are you looking at then? Is it your own funds? Are you looking at mortgaging? Or are you looking at teaming up with someone? You know,
Well, the traditional way is if you're in a fortunate circumstance, you have the full amount of money to buy the house. Now, very few people are in that fortunate position, and to have that, it can be it's a slow way to maybe build a portfolio because all of your capital or a large amount of your capital is locked into one or two properties. Whereas the conventional way is you put down a deposit, which is normally 25%, and then you borrow the rest of it, and that's generally through high street lenders, and it's on a buy-to-let mortgage. So when it's a buy-to-let mortgage, you have to factor in that your interest rate is slightly higher compared to if it was your own house that you were living in. So again, you have to factor that in to your costings. Is it something that you think that interest rates are going to stay, interest rates are going to stay for maybe 2 years, 3 years, 5 years? You're predicting that as well, and that in itself is a master. But I track that heavily.
yeah,
Having an economics background, I really enjoy that sort of thing. But no matter what, you can't predict it. Like last year they talked about interest rates dropping massively, and they'll be dropping at the tail end of 2024 and into the early part of this year. They're now not talking about that being the case. They're now maybe talking about inflation rising. So you can never predict it, but at the same time, it's crucial, because if you lock yourself in to a mortgage repayment and maybe your interest rate the interest rate drops, it means then you end up you're paying more than what you could have done. So it's a wee bit of a gamble.
and I suppose probably when you look at that, it's nearly every mortgage. When you're tying yourself in, is it what you can feasibly pay at the moment, or are you happy enough to pay this just so that you know that the rate is there, so that if it does go up, you're not going to be paying even more. So how then does the short-term rental, Airbnbs, apartments, maybe even that side of things, compare to the traditional buy-to-let? You've touched on it there where, it's going to be more hands-on. By hands-on, you mean you're going to be in making sure the place is clean, tidy, up to spec, making sure that the people are probably even booked in, in and out on certain times, because you might have people arriving on the same day, departing on the same day, that side of things. With your traditional buy-to-let, then once someone moves in, they're in a contract, that's it?
Yes. So generally, the short-term lets, the main one that you hear of is Airbnb, but if you're in that market, it's very common that you use maybe 2 or 3 different providers. So it can be quite difficult where you're juggling, where's that booking coming in, and it can be very common maybe you've got 2 bookings in. You have to factor in, those platform costs as well. I've seen it, where you're renting a property out for a weekend, and there's only so much you can achieve for a weekend, but yet when you factor in the fees, cleaning, all of that, you don't really get that much left over at the end of the weekend. You're thinking to yourself, that's not really worth the hassle. And it's a juggle between, there's quite a few people maybe do it themselves. So really what they're doing is they're taking that wage out of it, of which is probably just maybe at £10-12 an hour, whereas if they brought in a cleaner and do it all. So it comes back to what I said in one of the other podcasts. There's times there where you could just simply focus and put more efforts into your own job, where you could make more money, as opposed to if you're fortunate enough to be making £15-20 an hour plus in a job, and I see this a lot. Those people think, oh, I'm going to buy an Airbnb or I'm going to buy a property, and they end up doing the jobs, which are costing £12 an hour, and you're thinking to yourself, this isn't stacking up here.
Yeah, and it's not even as simple as that, but even simple things like if you're buying an Airbnb, the busy time of most weeks is going to be your Friday, Saturday, Sunday, which is your weekend, which means you're effectively going to be losing your weekends because you're essentially working them. So if you're used to Monday to Friday and getting Friday evening, Saturday and Sunday off, but you've now bought this and now you're working with that. Well, as you said, then you're working Monday to Friday in your job. You're now working Friday evening, Saturday and Sunday, for what realistically may not benefit you or may not. Is that again then where your strategy comes in? Is that what you want? Is that what you want to tie yourself to? Would it be easier to have a buy to let, have someone in there for 12 months or 24 months or whatever.
It's very easy to get caught up in the buzz of it. You know, everybody thinks it's great fun, and in those early stages, it does be great fun simply because it's something new, it's something different. You're not used to it, but you know, spend the summer 3 times a week going in and cleaning a house and changing bed sheets and things like that. Maybe you're used to that at home, Chris. I'm certainly not, and I'll point out I do what I can at home, Chris.
Yes,
So I don't want to get shouted at.
yeah.
I certainly do what I can. But what I'm trying to get to is really the monotony of it as opposed to the task, and you're doing that time and time again. And certainly then it ends up maybe at home does get a side game, and it starts to lack because you're running around after a few Airbnbs.
No, and I suppose even just to pick up on that point, you know, it's, as you say, the monotony of it, but also because there's a higher turnover of people coming in, you know, something could go wrong the first time, that's fine, you brush it off, you deal with it, but when it happens the second time and the third time and the fourth time and possibly the fifth time, and you know, you don't wish that on people, and hopefully anyone that does go into it, you know, there isn't issues, but there will be, you know, and when you're constantly having to deal with these things, whether it's broken chairs or, you know, something's happened, there's a hole in the wall because someone's fell into it, whatever, you know, you never know, and that's the risk you're taking with it. You know, that's where it starts to hit you a lot harder because you're thinking, here I am again, how do we try and fix this?
What I was saying there was like the generalised way of the newbies, if you want to call it, getting into it, and I'm not running it down, but it comes back to the strategy. If you've picked the right property in the right area, you're providing the right product, you're getting the right sort of money, it means you can run that Airbnb with little to no effort yourself, and that's where it should be at, where you have outsourced everything, or you have a company doing it all for you, and you're making those higher returns as opposed to the, you know, running around doing it all yourself. And that comes back to any strategy. You know, there's the pros and the cons of it, but the best way of maximizing your return is doing your homework, strategy, and just getting the right product.
I think you pinned as well, one of the previous episodes, it's how you are as a person as well. You know, if you're not someone that's willing to run around and do these things, don't put yourself in that situation, because it's not for you, and strategy is not for you. You know, if you don't want to be going in and doing these things, but you're unwilling to bring someone in to do it for you, it's not going to work for you. You know, so cash flow, we haven't really touched on it, but what would be the best way for your cash flow in terms of your strategy then?
So cash flow is something that's very important to investment, and to try and explain it in a basic concept, it means whenever your property is bringing you in money, and generally a lot of money, and then you're able to pay out all the bills, but you've enough money coming in to cover those bills and a wee bit left over. Whereas to compare it to the likes of if you were to, you know, put money in the bank or into an ISA, well, that's an investment, that's savings, it's making you interest, but that interest is normally only paid maybe once a year, so that's, you know, that's not a cash flow. Another example would be if you buy shares in a company, again, you own those shares, you'll get a dividend once a year, maybe twice a year, depending on the size of the company, and that's, you're only getting that money twice a year. Whereas the likes of property, you're getting your rent every single month, and you should be getting it fairly quickly from buying it to getting it rented out, to that rent coming in. Out of that rent, then you start paying out all your bills, and then at the end of all of that, there should also be a profit as well.
And as you say, and I think in your previous example you used there, when we were talking previously about, you know, if you're not getting the rent that covers your outgoings,
Everything,
you're running into negative, you're then having to use your own savings or what's left of your own savings to then cover the shortfall. It's not feasible.
I've seen people at seminars giving their examples of this is what I've bought, this is what I'm renting it out for, and they show a profit, but they're missing key other expenses. And whenever you factor that in as well, they might be lucky to have £50 at the end of the month, and you're thinking to yourself, you're taking on all this risk, you haven't done your homework here, and you're running around, putting all that time and effort into it, and it's costing you probably on an hourly rate compared to if it was in your job or doing something else.
It's back to them examples, you know, 3, 4, 500,000 pounds worth of debt for 50 quid at the end of the month. It doesn't stack up, and if the figures aren't stacking up, you know, you need to really look at your strategy as to what you're doing. I was going to touch on tax regulations. Again, is it being aware of that, knowing that you're going to have to end up paying it, building that into your strategy?
So I can't give any tax advice here as to what is the best method to go down, but certainly, you know, depending on what way your business is set up, depending on what type of property that you have as well, you have to bear in mind there's tax, and there's different rates in tax as well. A lot of people maybe overlook that, and a big killer is, for instance, if you have it down as a property and it's on your personal tax return, you have to pay your tax on the 31st of January, and then from that HMRC basically figures out, well, if you've made so much last year, well then they just assume you're going to be making the same this year coming in. So what they do is they ask for a payment on account then in July as well. So you end up having to pay tax, you're effectively paying tax twice a year, and that's something that you need to be predicting, working out in advance, so you've that factored in. There's a lot of people get caught out in that, they think they're making money, and then the next thing they get the tax bill in, they've overlooked that, they're trying to find the money, that then has a knock-on impact on their cash flow, and there's a knock-on impact on being able to pay all their bills, and then it can very quickly just snowball and get ropes around the ankles, and then you're in trouble.
Well, I was going to say, especially, you know, with the likes of HMRC there, like, you know, that's something where, you know, there's no voiding that. No. You know what I mean? If once they start to look for their, you know, their money and their letter comes in, you know, through the door, you pay it. That's it. Yeah. And I suppose, as you say there, and I know I'm not expecting you to give advice here or anything, but I'm kind of just venting. But I suppose for people then that are looking at, for example, you know, their incomes maybe sitting at a certain level, if they're on their personal tax return, that very easily, that money that's coming in from the property can very easily, as you say, take maybe into the higher tax bracket, and then they're paying then obviously a higher rate of tax then based on the fact that they've got, you know, that second property. So these are the types of things that, again, yes, all fall into your strategy.
A lot of people figure that out down the line, as opposed to doing it at the very start. And by that time they may be involved in it, and then they realise, well, actually it's not worth my while. But again, that's because they should have done that beforehand, and maybe they've looked at the wrong type of property to be buying.
Right, adding value then to your property. Is this where in your strategy you maybe identify certain properties and you've done your market research, you're maybe thinking to yourself, right, well, this area rents quite well, if I do a bit of work to the house, or, you know, sort of what could I maybe do here to add value to the property that would increase the rent? Is that stuff that you, again, build into a strategy with clients?
That's a good thing. What we find is somebody who would do this a lot or involved over years, they're watching the market, they get to know what areas do well, and at that point you can see if a property comes in the market, well, that could be one that could be, you know, maybe needs, you know, if the kitchen was upgraded, or even just simply remove a few ugly hedging or trees from outside or things like that. Where a lot of people make the mistake is to think, oh, I want to be a property developer, I want to get into this. And what they do is they look for the cheapest property, or they very simply look at what's the poorest looking property, or, you know, poorest quality that's available on the internet. And what you normally find is that's the one that loads of people are going for. They're all bidding against it, and it ends up the figures don't stack up. And I see that all too often, and then people either go sale agreed, or they're about to buy it and they realise, in fact, I've got this wrong. You know, the time you put in your heating system, you do this, you do that, it's maybe only going to be worth what you've paid for it. So it's about, you know, it's about knowing your market, you know, this knowing, you know, and you only know that, or you learn that if you're doing it time and time again. Anybody who's doing it, it's all about experience. They've learned it. It's not something that you just get like that.
You know, because there, even as you were saying, it could be as simple as upgrading the aesthetics outside. The house itself might be fine, but if you upgrade the aesthetics outside, you know, you could end maybe add 25 or 50 pounds a month onto the rents. If a slight tweak inside, you know, maybe make the house a wee bit bigger, or you know, this can all be beneficial. But again, it's back to, you know, you can add value, but you also have to put more of your own capital in to add the value. You know, and if that's not something that you want to do, you need to do that in your strategy. If it's something that you do want to do, then again, you can make that point.
Sometimes it could be as simple as I like a paint in one room, better photographs, and a different agent. And that can make the difference sometimes in £10,000 plus on the value of a house, literally.
Yeah.
So that's how easy it is, but it's identifying that.
Yeah. And not everyone will.
No.
You know, and as you say, it's down to the people that have the experience, that are dealing with it day in, day out, that understand it, that can see it, and be able to give that kind of guidance that here's what I think, and here's what you could possibly achieve based on this.
Yeah.
Right, let me see where we're at here, Roy. That was adding value. We touched there on the last episode about scaling your portfolio. Do you build that into your strategy kind of as, say, 1 year goals, 3 year goals, 5 year goals, and that's how you kind of identify how you plan to scale it then?
Yeah, because that's you're working into it as to, you know, what type of property are you buying. You know, are you able to inject more money into it? Are you going to be relying on the equity in the properties? Where are you buying? Because maybe, you know, some areas are going to have a better capital growth compared to others. So I have to be very cautious in how I say it, but generally that's the meticulous part of it, and that's where it definitely you have to put a lot of effort and a lot of time into it, and probably trying not to scale it too much too quickly.
And that's simply a case of then if you stretch yourself too much going on, you know, one problem knocks into a second, snowball effect, all comes tumbling down.
There's no point saying, oh, I want to have 20 houses in 2 years.
Yeah.
You know, that means yes, there's people out there that is achievable, or have achieved it, but you know, the faster you're trying to do it, it's not built on the foundations, as they say, and it makes it high risk.
Yeah. Right. How can investors mitigate risks during the potential market downturns? You know, we do talk about the fact that the market's always, you know, tends to, over the years, has considerably grown. You know, but it's a market. It goes up, it goes down, it fluctuates. We you know, that's just the way markets are. But how can you mitigate those risks? Is it being sensible with the houses that you're buying, the rental that you're charging, being sensible with your cash flow, making sure that you've got security, you know, a wee bit aside, as you say, in a pot that can kind of, as your emergency fund, whatever it happens to be, build this all into your strategy?
It's you have to factor in playing devil's advocate with everything, because a lot of people just automatically think the market's going to go up. And yes, if you research into it, it will say the market will, on average, continually rise. But that's okay. If you look at a market data for 30 years, it'll rise. But not everybody will have 30 years. So during that 30-year period, the market's going to be going up and down to get to that higher point. So if you're somebody who's later on in life, you know, and you start to see a bit of a dip, you don't have the time
to wait for the rise
to ride it out again. So you have to play devil's advocate in that. You also have to factor in, already said earlier, about interest rates, you know, predicting as well, you know, what if interest rates drop a wee bit? What if interest rates go up for your next mortgage term? Are you able to, you know, what if rents maybe have to stay the same? Well, then that's going to be eaten into your profit. Can you sustain that? There's normally a while where interest rates do rise for a particular period of time, maybe it's to cool the market before they drop. Like, to give you an example, back in the last recession, was it in around 2010, I saw experiences whereby interest rates were at such a level that the rents weren't even covering the mortgage. So that's something where I've experienced, and you're thinking to yourself, how can I, how long can I last here? And it gets to a point, what is the breaking point? If that interest rate was to keep rising, then that's it, it could be lights out for you. So it's a matter of how can you ride out that wee mini storm in the bigger storm. So it's a matter of, you be very cautious, you factor this all in, and just don't run away with yourself.
It's like relating that back to 20 properties in 2 years. And as you say, a wee mini storm comes along, that storm's taking you away with it, and it's even just a mini one.
That's it.
In terms then of the sort of the next, say, 5 to 10 years, then where do you see, say, property going in terms of even what you'd be thinking about in terms of a strategy, say, the next 5 to 10 years?
It's so difficult to predict. To give you an example, coming out of COVID, I had quietly predicted that the market was maybe going to drop, thinking to myself, there's going to be lots of job losses here, nobody can afford anything, everybody's going to be sticking their properties on the market, cashing in, and that would cause a drop. I was completely wrong. I predicted it was the other way around, because there's people had built up the extra money for that 6 months, 12 months period, and they were thinking to themselves, well, I want to make an investment. You had people who didn't like the house that they were in, so they were moving house, they were all getting bigger, trading up. So that's an example whereby I was predicting for the worst, but actually it ended up going better. So there's no way of predicting what way it's going to go. As I said earlier, with interest rate rises, you can be reading the data, watching the data, but then all of a sudden there can be a change in the markets. There could be a war, oil crisis, Trump. That's brilliant. He's doing good.
Well, I'm only mentioning him because if anyone is listening to it that is interested in markets and all the rest of it, he came out and said something in the early hours of this morning, and the market's just went into complete turmoil. In terms of, and I'm talking about stocks and shares here. I'm not talking about property markets or anything. Just specifically stocks and shares. Just the reaction to it. But even a figure like that, like him, can very easily say something and just bang. Away it goes for, and it could be a week, it could be a month, it could be 6 months.
And that's a wee mini storm. You have to ride that out. So I think if you're within your means and you always put a side of caution on it, well then that's all well and good. If you're not willing to put caution on it and you're very risky, well then you have to reap the consequences that come from it. That yes, things could go well, but at the same time, if they go horribly wrong, you're going to lose a lot more.
That's everything in terms of my questions, Roy. Thank you very much. Property investment strategies. We plug then, Roy, yourself. Obviously, you are dealing with these types of situations week in, week out, with clients, and they're obviously approaching you. When it comes to strategizing, are you able to help people sort of figure some of this stuff out?
Absolutely. That's what I love. I love in my job getting to know the person and seeing and having a chat, telling me what it is they want to achieve, and then setting that's the dream, and then setting the many goals as to how you can get there. And then it's somebody as well to be accountable to, whereby as in they're accountable to me. Are they hitting those goals? Are they putting the effort in, putting the hard work in to make sure that they get where they want to? I love to see people achieving and doing well.
Right, folks, anyone that is interested in that, give us a wee shout, and we'll certainly see what we can do. But that is episode 24. Thank you very much, Roy. And we'll be back for the next one in a couple of weeks' time.
Thank you.